Good morning and welcome to the fourth meeting in 2013 of the Finance Committee of the Scottish Parliament. And if I could just remind all those present to please turn off mobile phones, Blackberries, tablets, etc. The first item on our agenda is consideration of the Budget Scotland No. 2 Bill at Stage 2, and members have a note by the Clerk in their papers. Can I therefore welcome the Secretary for Finance, Employment and Sustainable Growth, who is accompanied by Andrew Watson, Terry Holmes and Janet Edgell from the Scottish Government's Finance Directorate. I'd like to invite the Cabinet Secretary to make an opening statement. Cabinet Secretary, welcome.
Thank you, Convener. I'd like to begin by acknowledging the work of the Finance Committee during this year's budget process. I have given careful consideration to the points and recommendations made in the committee's report and submitted my formal response to the committee on the 21st of January. This session of the Finance Committee focuses on the content of the budget bill itself as approved in principle by Parliament last week. As members of the committee will be aware, there are a number of differences in the presentation of budget information between the draft budget and the budget bill. In order to assist the committee, I will explain the main differences with reference to Table 1.2 on page 3 of the supporting document. Column A sets out by portfolio the 2013-14 budget as shown in Table 2.01 of the draft budget document published last September. Column J in Table 1.2 sets out the draft budget as it needs to be restated for the budget bill, and columns C to I provide details of the adjustments, including the necessary statutory adjustments to meet the requirements of the parliamentary process. There are two substantive funding changes to the spending plans outlined in the draft budget. Firstly, the budget reflects the impact of my statement to Parliament on the 19th of December 2012 regarding the deployment of £164.3 million of additional capital DEL in 2013-14. This is recorded at column H. In addition, as I informed Parliament at the Stage 1 debate last week, the local government budget has been adjusted to include the transfer of £328 million to the Scottish Government as a result of the arrangements that surround the changes to council tax benefit. The transfer relates to the devolution of responsibility in this area to Scotland and does not increase the discretionary spending power we have in 2013-14. I would again point out that we are addressing some of the impacts of welfare reform in a number of interventions that we are making, along with our local government partners, including funding of around £50 million to increase the Scottish Welfare Fund and to plug the funding gap that the UK Government has created through its handling of the abolition of council tax benefit. The other adjustments set out are the exclusion of £78.6 million of NDPB non-cash costs, which do not require parliamentary approval. These are mainly in relation to charges for depreciation and impairments, and include bodies in our NDPB community, such as the National Institutions, Scottish Enterprise and Scottish Natural Heritage. The adjustments also exclude judicial salaries and Scottish Water loan repayments to the National Loans Fund and the Public Works Loan Board, which again do not require parliamentary approval. The inclusion of police loan charges are to be approved as part of the budget bill. There are technical accounting adjustments to the budget of £92.2 million, reflecting differences in the way that Her Majesty's Treasury budget for these items and how we are required to account for them under International Financial Reporting Standards-based accounting rules. IFRS-based accounting was introduced across central government from the 1st of April 2009, and I would remind the committee that the conversion to an IFRS basis is spending power neutral. The adjustments to portfolio budgets to reflect the requirement that a number of direct funded and external bodies require separate parliamentary approval. These include National Records of Scotland, the Forestry Commission, Teachers and NHS Pensions, the Food Standards Agency, Scottish Court Service, the Office of the Scottish Charity Regulator and the Scottish Housing Regulator. The restatement of those specific grants included in the overall 2013-14 local authority settlement, which remain under the control of the appropriate Cabinet Secretary with responsibility for these policies, are also excluded. Housing and hostel support grants, for example, remain the responsibility of the Deputy First Minister and Cabinet Secretary for Infrastructure, Investment and Cities. Full details of all grants treated in this way are included in the summary table on page 74. I would again make clear that these are essentially technical adjustments and do not change in any way the budget that has so far been scrutinised by this and other committees and approved in principle by Parliament. We have taken the opportunity at the Budget Bill to reflect a small number of budget transfers in order to provide clarity on the starting point for portfolios. The most significant budget transfer is a £14.8 million transfer from local government to rural affairs and the environment portfolio to support the Next Generation Digital Fund. I would also remind members that for the purposes of the Budget Bill, only spending which scores as capital in the Scottish Government's or direct funded bodies' annual accounts is shown as capital. This means that capital grants are shown as operating in the supporting document. The full capital picture is shown in Table 1.3 on page 4. As I made clear to Parliament last week, I remain committed to an open and constructive approach to the 2013-14 budget process and continue to seek agreement on a budget which will meet the needs of the people of Scotland during these challenging times. I hope that members of the committee have found these remarks helpful, and I'm very happy to answer any questions the committee may have.
Thank you very much, Cabinet Secretary. I'd like to ask any members of the committee if they have any questions they wish to put. Michael, to be followed by Gavin.
Thanks very much, Cabinet Secretary. Just to get clarification on the announcement, the funding announcement last week in relation to money advice. Can you confirm that this was consequentials, the £5.4 million? Were they made up of consequentials which came directly from the £65 million which was made available by the Cabinet Office, which was match funded with the big lottery? And was there a £1.7 million consequential included in that 5.4 also?
Well, as Mr McMahon will be aware, the government receives consequentials from the UK government for a whole range of different factors across the different areas of spending activity. And what administrations have consistently done, and this administration is no different, is acknowledge, and this is acknowledged by the UK government, that the Scottish government is free to allocate consequentials as it chooses to allocate those resources. So there have been a number of examples of that over the years where consequentials have been provided as a consequence of decisions taken in the United Kingdom government, and the Scottish government is then free to allocate those as we see fit. And the announcement that was made last week essentially allocates additional resources for advice services in 2013-14 and 14-15, and also in 12-13, and we've set out the approach to that in the announcement last week.
Can you confirm, and I've asked this before, I know that you said that it was your practice not to ring-fence that funding. Can you confirm whether this money is going to go to local authorities for distribution, or is it going to be centrally dispersed money?
The funding distribution arrangements beyond the the headline allocation of 1.7 million have not yet been set out. There are discussions between the Deputy First Minister and relevant organisations as to the most appropriate method of taking that forward. So the precise distribution of that £1.7 million is not confirmed at this stage.
Okay, thanks very much.
Thank you, Gavin.
Thanks, Can we just a couple of technical questions, if I may. Table 1.2, to which you referred, Cabinet Secretary. Column C on there has 3 entries, 328 for local government, which is explained on the previous page, 27.8 for infrastructure, which is explained on the previous page under Scottish Water Loans. The third column, though, minus 24.1 on the justice heading. Are you able to explain that figure?
That will be judicial salaries, isn't it? Yes, it's judicial salaries which don't require parliamentary approval.
I suppose the reason I ask is that because on the previous...
And also police loan charges.
Okay, because on the previous page, page 2, it says judicial salaries of 30.3 million appear in the draft budget but excluded. So I mean, I had read that, but I couldn't tie up the 30.3 with the 24.1.
Yeah, it's essentially the 24.1 is a net figure taking account the gross figure of 30.3 in relation to judicial salaries, with the netting off of the police loan charges, which is of the order of £5.8 million.
The second technical point, though, is the That table 1.2 under column J has the restated budget taking into account adjustments and consequentials from the 5th of December. When you go through the rest of the document, you've got 2012-13 and then you've got 2013-14 for each of the portfolios, and then for each broken down to parts of the portfolios. Do the 13-14 figures throughout the rest of the document reflect those Barnett consequentials, or are those figures the initial budget figures, if you like?
On 13-14.
If you take, maybe if I choose a specific page, it might. If you take page 17 then of the document, which is health and well-being, at the very top right hand under total, you've got 12043.1. Is that figure, was that the initial budget under health, or is that the budget now, having taken into account Barnett consequentials and adjustments and additions and so on?
Take into account that a table such as the one on page 17 essentially will reconcile to table 1.2, although in saying that there will be various factors in there, such as the way in which capital is accounted for and what shows in our balance sheet and various factors like that. But that takes into account capital consequentials.
Yeah. And page 16 gives a summary of the health portfolio. Which
only the Cabinet Secretary is allowed to speak during the stage 2 of the budget.
Sorry.
So those tables will reconcile with table 1.2.
And just finally, in comparing, if you take page 17 again then, in comparing the total figure for 13-14 versus 12-13, is the 12-13 figure the final figure, if you like, for 12-13, or was that the initial budget figure? Does that include consequentials and so on?
Yeah, that's the original budget approved by Parliament in the budget bill process as at February 2012. So there will be subsequent changes to that through the autumn budget revision, which will not be shown in 12-13, and that would be the only other formal parliamentary process that could have been undertaken to change those 12-13 budget totals. Obviously there is a spring budget revision which is yet to come.
Thank you.
Okay, thank you. There appear to be no further questions from committee members, so we now turn to the formal proceedings on the bill. We have no amendments to deal with, but are obliged to consider each section and schedule of the bill and the long title and agree to each formally. We'll take the sections in order, with schedules being taken immediately after the section that introduces them and the long title last. Fortunately, standing orders allow us to put a single question where groups of sections or schedules are to be considered consecutively, and unless members disagree, that is what I propose to do. Members agreed? Thank you. Members have signalled their agreement. Firstly, the question is that Section 1, Schedule 1, Section 2, Schedule 2, Section 3, Schedule 3 and Sections 4 to 11 be agreed to. Are we all agreed? We are agreed. Secondly, the question is that the long title be agreed to. Are we all agreed? Yes. We are agreed. That ends stage 2 consideration of the bill, and I'd like to thank the Cabinet Secretary and his officials, and just allow a couple of minutes for them to leave and for the new witnesses to be seated. Thank you. reconvene in a minute or so. It's 10 seconds. Our second item of business is to take oral evidence as part of our Stage 1 scrutiny of the LBTT Bill. Can I therefore welcome to the meeting David Melhuish of the Scottish Property Federation, Michael Levac, Scottish Building Federation, and Mr Philip Hogg of Homes for Scotland. And we're going to go straight to questions this morning. But first of all, I'd like to thank you for being here 10 minutes earlier than was scheduled. The earlier item having ended much more quickly than it was anticipated, which means that we've got even longer to interrogate you this morning. I think my first question will be to Mr Philip Hogg, and I'll ask just a few opening questions before I allow members to come in. And it's, I'm quite intrigued by paragraph 8 of your submission in terms of tax avoidance, where you say it is important that anti-avoidance rules are in line with the rest of the UK to ensure rules are consistent and understood. We do not want Scotland to be seen as somewhere more challenging to invest in, with a high price to pay for legal accountancy advice manoeuvring from investment across the board. And all the evidence we've taken so far is that the anti-avoidance rules are a shop full of holes, and in fact ensure that the people who are supposed to pay often do not pay, and therefore you know, people such as the Lost Society of Scotland and others are of the view that we need to have very strong anti-avoidance rules, not to deter investors but to ensure that tax is collected fairly. So I just wonder if you can expand a wee bit further on your thoughts with regard to tax avoidance, Mr Hogg.
Okay. I think, just for clarity, we would not support in any way tax avoidance in any sense of the word. So if that inference is there, please take my word that it wasn't intended that way. I guess with any tax system, we need to be ensure that it's fair, accurate, proportionate, and indeed can be administered in the most effective manner possible. So in setting up a new tax system, we want to ensure that people understand it and it's easily collectible and tax avoidance is minimised. So let me just clarify that there was no inference there of supporting or encouraging any tax avoidance. Hopefully that clarifies our position there. But equally, we'd want to ensure that we're conscious of many of the organisations that are members of ours operate north and south of the border, and they make investment decisions on the attractiveness of doing business in either Scotland or England. So as a general point, we need to ensure that Scotland remains competitive. Take, for example, a large PLC that has many £million to invest in land. They would take a decision on where they thought they would get the best return on their investment. And that takes into consideration the cost of doing business, the cost of the regulations, the cost of business, cost in general of doing business. So we wanted to ensure in our point here that Scotland was not disadvantaged or not seen to be an expensive place to conduct business, and hence would encourage their investment.
Okay, colleagues who are giving evidence can also comment on these questions if you, I mean, although I asked that specifically because it is in your own submission, but if other people want to comment on this, please feel free. And when I ask other questions of others specifically, Mr Hogg, you can feel free.
I think generally, and it's maybe an obvious thing to state, but having worked very closely with HMRC over many years on a whole host of initiatives to assist the construction and property sectors in I suppose, navigating their way around the current complex system, and their experts acknowledging that tax around land and property and construction-related activity is amongst the most complex tax system that we have. And I think if this is a start, giving us in Scotland an opportunity to have a fair and simple system that maybe tries to avoid unintended consequences and is simple to operate, simple to understand, then that would be most welcome, I think, right across the property and construction sector. How you actually achieve that, I would hope that, you know, the civil servants that are looking to the implementation stage would be able to come up with some ideas in close consultation with industry. But I think we should never lose sight of the objective of trying to put a far simpler system in place.
Convener, just add that I think there's a danger that sometimes there can be a knee-jerk reaction to concerns about anti-avoidance. And we've seen this, we've got the 15% rules coming in under current SDLT, which will affect everybody for the next 2 years in Scotland as well, on residential where there's a non-natural investment made in high-value residential properties. Now, no one from our organisation or our colleagues, British Property Federation, opposed that idea in principle, but unfortunately it turned out that legislation actually caught genuine property investment businesses, and it took 3 or 4 months now of quite hard work with HMRC, as Michael has identified, to try and explain this to officials, and we're in the position whereby that argument has been accepted and changes have been made, but won't be made in time for the legislation actually coming into force next month. So you have a concern that inadvertently measures against tax avoidance can actually catch genuine business transactions, which wasn't the intention of, in this case, the UK government. And I think that would be a concern that we need to make sure doesn't happen in Scotland.
Okay, Mr Hogg, in your submission you also say that we would support the reduction of tax chargeable to the lower end of the market from 1% to 0.5%, obviously in order to kind of stimulate demand, and you say improving tax revenue, but is any work being done to show that it will actually do that? You know, what is the elasticity of demand in that sector? Would such a reduction be enough to stimulate demand such that it mitigated the loss of revenue from the reduction?
I think that what we have to take note of the overall economic circumstances. Housing transactions in total are dramatically lower, probably 40–50% lower than at their peak in 2007. Added to that, we have a growing population. And number of households are growing on the housing waiting lists. So there is a pent-up demand on there, and the reason that the transactions aren't taking place are numerous, but undoubtedly cost of moving, the cost of the transaction is a big barrier. And stamp duty land tax is one of those barriers that home movers face. And the reason that it's been exacerbated is because of the bank's lack of willingness to provide, rightly or wrongly, higher loan-to-value mortgages, meaning that home movers have to provide a higher deposit or higher degree of equity to move onwards. So any minimisation in the tax or the cost of moving is going to stimulate or certainly facilitate more people to be able to move onwards. Hence our suggestion of trying to minimise the tax and make it more easier for those that wish to move to be able to move.
I mean, to actually get the same amount of tax revenue, you'd have to double the number of transactions. Is that, you know, otherwise the Scottish Government would lose considerable revenue, which would obviously impact on the kind of services that we provide here as a Parliament. So what evidence is there that there would be that kind of level? I mean, my understanding is that, you know, the bank's unwillingness to lend in general economic uncertainty is more of an impact than stamp duty at this level.
I think that we need to take the discussion much wider than stamp duty land tax, because we know that that housing transactions have a significant multiplier effect on the overall economy. Homes that are built or the housing market generates economic activity, generates employment. And I think that we need to take the discussion much wider than looking at the numbers of housing transactions, and take that thinking a little bit broader to look at the overall economic impact. And it may be that the transactions in themselves don't create a net neutral effect, but when looked at the multiplier effect, there's a much greater benefit to the economy. And I think that's where we'd be keen to look at some broader thinking.
I don't disagree with that at all, but what I'm concerned about is whether or not the increase in transactions outweighs the reduction in revenue would be the issue. And just to move on to Mr Mulhughes and his paper, I mean, you talk about LBTT is constrained in its development because of the requirement to broadly achieve revenue neutrality. But if there's not going to be revenue neutrality, again, you clearly, the implication is that there should be a reduction in the taxation raised through LBTT. But that obviously has an impact on the rest of the Scottish bloc. That means there'll be a reduction in the ability of the Scottish Parliament to spend in areas if its income is reduced by this measure, is it not?
Well, I think you identify the constraint we're talking about and the uncertainty that arises around that at the moment. I mean, as we understand it, that is still something being negotiated between the Scottish Government and the UK Government, and the volatility of this particular tax makes that a very difficult target to achieve with any form of certainty. And, well, we're about 2 years until the tax comes into force, so time is running out. But just to refer to earlier question, I think there was some evidence where there were stamp duty holidays introduced at the beginning of the 90s recession, which got economic activity going. And again, Philip's points there made on the wider impact of how property transactions can help the wider economy, I think, are very important in that. But I think there might be some evidence that officials might pull out that actually that got activity within property transactions to such a level that revenue then quickly came back. So I think it's a time issue that you're talking about. How quickly would the increase in activity and henceforward the increase in transactions regain the revenue that you were looking for? So I think there's a time factor that you'd need to consider.
Yeah, I think I'd probably just add to that in terms of the volatile nature of the returns of the existing tax regime, obviously as a result of the volatility in the current property market. I think there's concern about the reduction literally overnight when the tax comes, the new system comes into place, that the reduction in the block grant from the UK government to the Scottish government and whether there's some transitional arrangements to be considered there, just to make sure that the block grant calculation is on the most up-to-date figures that are realistic. I think the other thing to pick up at this point when we're talking about the implementation date and the market uncertainty, I understand from the consultation process that the Scottish Government does not intend to publish the detailed proposals regarding the rates until very close to the implementation date of April 2015. That it clearly could introduce a bit more uncertainty in the market, and I think it would be helpful if the proposed rates and the detail of that were made public, probably far in advance of the implementation date. Equally, obviously, the rates can change. It will then be up to the Scottish Government at any point to change those rates. So if we get a simple system that is simple, balanced and fair, then at any point those rates could change. But I appreciate your point in terms of, if you simply reduce the tax in one area, you've got to make it up somewhere else. It's not quite as, it's a balancing process.
Yes, indeed. I mean, this is the Finance Committee often is that issue where people either want to spend more money or reduce money somewhere, but we don't get the same information back in terms of how that can be found elsewhere. I mean, I think one of the reasons the Scottish Government actually is proposing what it's doing is to try and is to allow for concerns over volatility, because OBR projections, Scottish Government officials believe is wildly optimistic in terms of revenue take in the years ahead, and that's something which concerns us all. Ms Mulhughes, and I have to say all the papers are excellent, but in this section of your paper, simplicity and fairness, well, there's an explanation here. Just for the record, I wonder if you can actually touch on what you've said with regard to that. What you've said is simplicity and fairness are key tenets of the new tax. Unfortunately, these two objectives can sometimes contradict and conflict with each other. And as I've said, although you do have an explanation in your paper, I wonder if you can, expand on that for the...
Yeah, I think the feeling there is obviously the simpler the tax, it has a benefit in terms of it's understandable and certain for everybody, but it's not always fair. And in terms of trying to be able to ensure, for example, that reliefs for positive purposes that you might want to introduce are brought in, or to incentivise certain parts of the market, you will inevitably introduce a certain amount of further complexity into it. And you'll probably see it in some further detail if we go on to discuss the issue around commercial leases, for example, where the Scottish Government are very keen to try and introduce a system that is seen as fairer to the taxpayer. There's currently the issue of the big upfront payment, for example, and there's an enormous amount of complexity involved in the current creation of that tax in terms of net present value and so forward. But on the other hand, the most simple approach, which is gaining a lot of interest at the moment, simply having an annual tax on the lease which is paid on the actual rent that's paid for that year, which seems entirely simple, very fair. On the other hand, might introduce other problems, such as ensuring the revenue that the government are looking for from that level is achieved on a year-by-year basis. Well, it's unlikely that that would be achieved at this stage. And also, whether you might actually be inadvertently getting people out of the tax system who you want to tax at the moment, or in other words, introducing other taxpayers into the system. So I think the very simplicity of it introduces a number of wider policy areas of concern to the government that then grate against that desire.
Okay. Did Mr Hogg or Mr Levac want to comment on that?
I think only to say, in terms of this issue of simplicity, I suppose the more complex the system that's introduced is, then the more chance larger companies who maybe have the resources and have the wherewithal to pay for experts to find a way to minimise their obligations, whereas maybe small and medium-sized companies operating in property markets might not have the same benefit for that. And I just think it's the more complex it is, then the more chance you have of people, or highly paid advisors coming up with systems to try and flout the rules or bend the rules.
Yes, I mean, I think one of the reasons why some of the professionals who are working on this from outside the Scottish Government are so excited by this bill is the fact that they feel that the system at the moment doesn't really work effectively at all, and it's so full of holes it gives us a chance to try and address some of these matters. Now, Mr.
In terms of getting accurate information on terms of what the current take is in tax, what it may be, then certainly probably more so my two colleagues, but the information I have from their membership, I think that's where we've got to come into play, working with officials in terms of maybe looking at what if scenarios based on fairly accurate data that we can get from our members in terms of real activity rather than theoretical work in that field.
Okay. Now, Mr Levac, I'm obviously going to turn to you next before I open the session out to colleagues round the table. And we talked about simplicity, but you have a fairly radical suggestion in terms of homes with a poorer energy efficiency rating incurring a higher rate of LBTT, whereas homes with a higher energy efficiency rating would incur partial or total relief from the tax. Which does seem interesting and innovative. I'm just wondering how that fits in with simplicity and how that would work, and what your two colleagues would have to say on that particular matter.
Well, I think it's any of parts of the construction and property industry are looking for some way of stimulating activity. I don't think this one tax isn't going to provide all the opportunities to provide that stimulus. In terms of energy efficiency, it just strikes us that in some respects a lot more needs to be done. We would never want to get into a position where we're arguing a new build versus current stock, but we need to do something to encourage and almost, I suppose, reward those that are spending money in terms of maintaining their buildings getting existing stock up to more modern standards in terms of energy efficiency, and we see this as being one of the measures that could be achieved, whilst putting the big health warning that we've got to be very careful in terms of listed buildings, historic buildings, where clearly the costs of achieving energy efficiency will be considerably higher than newer or modern or new build properties. So yes, that you could argue that we may inadvertently be suggesting some complexity whilst wanting simplicity, but I think it's not beyond the wit of man for us to be able to achieve something that helps promote better energy efficiency in the built environment.
Okay. Mr Mulhoosh, do you want to comment on that?
Good example from Michael there on my last point. It's it is obviously a desirable objective, but I mean we have had an attempt at the new carbon homes and it failed. You might as well just surmise that it failed. I think we're not against it, but we'd like to see exactly how the government would want to attack it. I mean, at the moment, the tax is related consideration and tied to the value of a property, and the interrelation of value and energy efficiency, particularly for older properties, I think is something we have a lot of concerns about at the moment. And if, because of other provisions of government, because I think we have to look at this as a cumulative impact on government policy across the piece, you actually see values being reduced if they have to bring the properties up to a certain standard before they can be sold or leased, then we would certainly want to avoid a potential double whammy via the taxation system as well.
Okay, and Mr Hogg?
I think that this is a very interesting and area for opportunity to push forward on other policy areas. I watched with interest yesterday the coverage of the update on the carbon emissions targets at the debate in Parliament, and this is an area that gives us the new homes industry equal measures of concern and opportunity. The government is proposing higher standards for new build for all the reasons that we understand. I won't go into the debate as to whether we think that they're disproportionate or not, but you'll probably sense from the way I'm speaking that we do. The situation is that whilst we understand the need to reduce carbon, the biggest emitters of carbon are existing homes, not new ones. So that's where the opportunity stroke the problem lies. Now, simplistically, you could assume that there could be a linkage between stamp duty and the energy efficiency of a home. In other words, rating the stamp duty payable on the energy efficiency of a home. And on the face of it, that offers some interesting thoughts. However, what we wouldn't want to encourage, or what we wouldn't want, is to create stagnation in the marketplace. In other words, reasons for people not to move. I think we could be looking at opportunities to reduce the tax for highly energy efficient properties, and I urge a word of caution on zero carbon properties, because that area is still yet to be clarified. It's an area of much debate, but I think homes that are almost zero carbon or very low carbon emitters, I think there's some opportunity there, but not at the expense of stagnating the entire market. But if the government wishes to achieve a drive towards lower carbon outputs from the whole housing stock, which is what Mr Wheelhouse was suggesting yesterday, then clearly action needs to be taken across the whole housing stock. But putting a tax on transactions, i.e. only taxing people at the point where they're planning to move, could have the opposite effect of saying, well, it's just too expensive to move, therefore we'll just stay where we are. The other route that could be explored, and I think, again, this is probably outside the remit of this, but I think there's a connection. The other route that could be explored is through council tax. That would be a point whereby, again, the energy efficiency of homes could be positively linked to the amount of council tax paid. So I guess the point I'm making is that I don't think we should look at SDLT as one specific tax just to pull one lever. I think we need to look at all of the taxes that are possible if we're going to try and achieve the carbon reduction targets that the government is committed to achieve.
Okay, I'm going to open the session out to colleagues, and the first questioner will be Jamie, to be followed by John.
Thank you, Convener. I'm going to stick with this particular subject matter actually, and pose a question of Mr Levac about this area. I think you described this proposed scheme would be somewhat comparable to the system of getting an MOT for your car, which I thought was an interesting analogy. But of course, the person who pays for an MOT is the owner or user. You know, if this is, and I would at least congratulate the Scottish Building Federation for making a positive suggestion, Convener, but if we want to explore it further, you know, in this proposal, who would pay for the assessment of whether or not a property was energy efficient?
Be the owner. Be the owner. And I appreciate, you know, when you suggest things like this, obviously if there's no system in place currently, everybody says, oh, another tax, another burden. I think we've got to reflect on where we've gone as a society maybe over the last 10, 15, maybe 20 years, particularly when bank finance was readily available. And if we look at the existing stock, and you know, many of us meet friends, family, colleagues, people you come into contact with who have built up little portfolios for themselves in terms of property, the one thing that seems to be seriously lacking is people actually being prepared to maintain their buildings. And there's obviously all sorts of ramifications from that. And at the worst end, without scaremongering, clearly, you know, major structural faults that can impact on the safety of both the tenants or people living in the properties or using the properties and those passing by. But equally, a whole host of opportunities to improve energy efficiency. You know, we've had the government targets published. We had the Sullivan report. You know, we've got lots of targets and lots of desires. We've got, you know, claims of, you know, world-leading climate change legislation. But actually at grassroots level for the construction sector, and let's be quite clear here, you know, you guys see, obviously, in terms of vested interest, shall we say, from the various witnesses you have this morning, obviously coming at it from a slightly different angle. In terms of trying to stimulate some activity in the repair, maintenance, improvement market, and if we just flick to another tax, obviously a reduction in VAT, which the Scottish Government and other parties support, would help even more, we believe, in encouraging people to undertake the proper level of repair and maintenance. Because after all, you've got to do it on your car. Why shouldn't you be encouraged somehow to do that on your home or your building? To do nothing, I think we've got an opportunity here to hopefully use this as a tool to stimulate some work and improve energy and efficiency and just look after existing built environment.
Sadly, of course, the Scottish Government doesn't control VAT at this moment in time. If the aim is to improve energy efficiency, then presumably the incentive has to be that it's going to cost more if you don't undertake remedial work to improve the energy efficiency of your home through the taxation you're going to be levied. I mean, is that realistic?
Well, it's whether you look upon it as being more or whether you pay the rate published, whereas you can get relief if you undertake certain measures to improve the energy performance of your building. But we're going to have to do something. I would suggest, again, from speaking to many people across the industry, the long-awaited Green Deal doesn't seem to, there's certainly not many, I don't find many builders, plumbers, electricians, you know, chasing that as an opportunity to stimulate work. I don't hear people talking about it, that they, you know, as building owners or homeowners, looking at the Green Deal has been the fix to improve energy efficiency. We've got to find some measures to assist and stimulate some activity. To just do nothing, I don't think is the answer. Equally, it's not to come in with a heavyweight regime that penalises householders in a time where, you know, many households are struggling. There's got to be a balance there somewhere.
I agree with your perspective, and Tyler, I'm just wondering if this is, you know, how this could be made an efficient way of doing it. And I suppose my perspective would be people are going to look at it in terms of brass tacks. If it's going to cost more for them to undertake the necessary repairs to their home than it is in terms of their tax liability and increased tax liability, or if they don't qualify for a discount, depending on what way you look at it. I just wonder if they're likely to actually undertake that work. But can I pose another question, because there's also been reference to the fact, and indeed your own paper refers to that, and I think Mr Mulhoosh also referred to this in terms of the zero carbon homes relief, and I think essentially you both said, you know, it failed. So why would this work where that failed?
Well, I think equally we could express views on in terms of energy performance certificates and the whole, you know, the reports that are done when people are coming to sell a property, and perhaps what we're suggesting is, you know, if we call it an MOT, is maybe just moving that on slightly, yeah, from where we are. But I think it's for us engaging with the government and legislators to come up with a system that can actually stimulate activity, and you'll never please everybody. I mean, no system will be perfectly fair. There'll always be somebody that says it's not equal and fair. But I think we've got to, given the opportunity, it's a major opportunity here, then we should do something. I think not to consider that would be wrong.
Okay, thank you very much. I'd like to turn to Mr Hoggever. I'm a convener, and at point 14 of your paper, you set out that you favour a reduction in SDLT rates to assist the lower end of the market, but you also suggest of a need for awareness of the impact that higher tax could have on the attractiveness of the higher end of the market to investors, and you posit the question, if the tax acts as a disincentive to high-end investors, will this push investors into the lower end of the market, thereby increasing pressure on affordability? Will it?
I think that what we have to understand, and the analogy is often quoted of the housing ladder, that we need a housing market where we have equal movement at all stages of the ladder or the chain, whichever description you want to use. And by disproportionately incentivising or penalising at any particular points creates blockages. It's fine in theory, and who would not want to help first-time buyers and help them get their first foot on the ladder? But if that's at the expense of making it more difficult for second or third steppers, what the net result is, we create stagnation. That whilst first-time buyers may be able to get onto the ladder, if there isn't the stock there, then there aren't the homes for them to buy. Because the stock will only become available if people are prepared and able to move at second, third and fourth steps on the ladder. So we need to ensure that all steps of the ladder are equally or appropriately taxed and incentivised. And this is the point that we were making here, because if we create blockages at any particular points, then either people don't move, or they maybe consider purchasing properties at lower price points just to avoid the costs. So that is, I think, the fundamental point. Yes, it's nice and it's attractive and it sounds good to help people, first steppers, but we need to ensure that the whole chain is moving, because sadly we're not building enough homes for first-time buyers or anyone else to have surplus stock around that people can just move into.
I mean, clearly that you're referring to the availability of stock, but that's two issues there in terms of the current stock that exists, but also new stock that comes online, and clearly your members are in the business of building houses. So, and we've already heard in terms of the current setup that it acts as a disincentive to the building of homes that would be valued around the marginal rate. So clearly this tax can influence the building of homes as much as movement on existing stock. So is what you're saying that this isn't going to affect the construction of new stock, the new tax that's created? That's not likely to affect that in any great way?
I think it's because we don't know yet exactly how the tax system will be structured and the rates that will be set. It's almost impossible to answer that question. But from the information that we have and from the information that we're aware of, what we're trying to propose is a system that doesn't create blockages and that is fair for all. And also picking up on the point that you raised with Mr. Levac, I actually think that we should be incentivising for zero carbon homes. We should be incentivising through the tax system for zero carbon or low energy homes. I think that that sends a very positive signal to the population. It's entirely supportive of Scottish Government's position, and I think but by withdrawing that, the fact that many homes weren't built or none were built is a signal that that's how difficult and expensive that it is. But nonetheless, withdrawing the incentive, I think, is not the right thing to do. And if I'm able, Mr. Convener, I've been asked on behalf of Scottish Federation of Housing Associations, who weren't able to be present today. They have contacted me and provided me with their paper and said that they were happy to present their views. You'll see in their paper also they're very supportive of retaining the incentive for zero carbon relief. So I think it's important that we send the right signals to the marketplace in terms of the direction of travel, but acknowledging that these things are difficult in reality to build.
I mean, it is the case that this form of taxation, and it obviously depends on its finer details, but it can influence the new build market as much as the market for existing homes.
It could go both ways. It could incentivise or it could disincentivise.
So it can influence it. I suppose I wasn't saying incentivise, it can influence it. And I suppose you answered that.
Yes. Mm-hmm.
Okay, thank you.
John, to be followed by Gavin.
If I can just follow on one more point on the zero carbon or low energy, or however we're describing it. The point was made to us in a previous session that it's all very well you can set the standard at one level and people get a relief or whatever, an incentive. But I mean, hopefully we're trying to raise the level. And that's quite difficult to build into legislation. I mean, I'm just wondering, would it not be much simpler just to give people a grant rather and leave the tax outside the zero carbon thing?
A grant to whom?
Well, either the builder or the purchaser or somebody who's adapting their house, that kind of thing.
I think that we have to understand the consumer psychology on low energy or zero carbon homes, whichever we care to choose, whichever phrase we care to use, is as much as that everyone or most people seem to think that this is the right thing to do and we should be going in that direction. The reality is, and we have to face up to reality. The reality is it's very low down the list when it comes to priorities for new home buyers. For most new home buyers, energy efficiency of the home isn't something that they take particularly a great deal of interest in. It's taken as a given.
Yeah,
we assume that it's low energy.
That would suggest that tweaking SDLT will have, land building and tax, would have virtually no impact if it's already low down and we're talking about varying 5% or 6% or something.
This is where the dilemma comes in, because whilst construction costs will progressively increase to achieve zero or low energy homes, the buying public doesn't place any value on it, and the lenders don't place any value on it. So home A, that may be super energy efficient, built today, right next door to home B that may be 100 years old, the valuers and the lenders will value them on an equitable basis based on normal comparables of the size of the home. They will not reflect the energy efficiency of the home.
Somebody knows they're going to pay less for their energy bill, be the bigger incentive?
No. The reality is it makes very little difference to the majority of home buyers. And I know that might sound odd and I know that might sound contradictory, but it is a fact. Our members tell us that when they have undertaken serious marketing or activity trying to sell on the basis of energy efficiency, it doesn't stack particularly highly in new home buyers' considerations. They assume that it will be energy efficient. They assume that there'll be lower bills. It's not a reason to purchase in itself. And it doesn't for the majority, no, I'm not saying for all, but for the vast majority, there is no evidence to suggest that having a super highly energy efficient home will make a significant difference on their buying process. All the other fundamentals have to be in place. It has to be in the right location. It has to have the right layout. It has to tick many other boxes. Energy efficiency still comes some way down that list, sadly, but that's the fact.
Right, to move on to another area, The suggestion was made earlier on, I think it's in some of the papers, that a simpler system would be popular, but there's also a suggestion that we don't want to move too far away from the UK system in case the developers get confused. How do we balance these up? I mean, are we saying that if it's much simpler, we don't mind if it's far away from the UK system, or are we saying we'd rather have a bit more complexity if it makes it closer to the UK system?
The view I've expressed this morning is simplicity,
yes.
But I'm saying that from a view of a trade body representing builders, the construction part of the sector, and indeed from a solely Scottish point of view. So without being flippant, I'm not particularly bothered what happens south of Hadrian's Wall and if there is a difference. But the point I did make is in terms of small and medium-sized operators in this market who, if it's a complex system, may not have the wherewithal to employ very expensive consultants to navigate their way through the system.
Yeah, that's helpful. So you're quite clear that you really want a simple system. Is that, would the two of you, the rest of you, agree with that?
I would just add that we fall into the realm of perceptions here is a problem, and you can have major investors who at the moment on the commercial side of things know that they've had a top rate of stamp duty land tax of 4%, and that's been in place actually for quite a long time now, and is at the same threshold in the kind of properties they deal with. So when you say to them the system may be moving potentially to 4.4%, but that's not quite the whole picture because it's going to be on a progressive basis, so you'll only be paying 4% above $500,000 and I think it was 3% above, or above $250,000 and 3% above 150,000 or so. Then they start getting, right, well, what does that mean to our values? And I say you fall into the realm of perceptions as much, and that would be the slight concern. But certainly we're in no doubt that residentially it's not just about simplicity, it's removing distortions. And I think the move to a progressive tax is the right thing to do on the whole.
Yeah, thank you. I mean, another area that's been mentioned a few times is making the system competitive and incentivising the market and all these kind of phrases. I mean, does that basically just mean you prefer a lower tax?
Well, for the reasons which I think Philip identified earlier, which very much applies to the commercial world, and in a sense, it's that those PLC boards have always been the dominant player in truth in Scotland. And yes, they're making decisions on looking where they make their investments, and nowadays those decisions can fall on ever smaller margins. I mean, I'm not saying it's the decision breaker, it's one in a number of factors, but certainly for our members, we want to be as competitive with what's going on in terms of this tax and the UK as possible.
I mean, competitive means obviously different things to different people. I mean, in some sectors it might not be the case in property, but you know, for example, having an educated workforce is seen as a competitive advantage. So then we might face the choice of an educated workforce and higher tax, or a less educated workforce and low tax. I mean, are you neutral on that, or do you have a preference one way or the other?
Well, I think, as I say, this tax, you want to be careful that it will only ever be one in a range of factors, and the employment workforce, the quality of life for that workforce and attractions of bringing people to Scotland, connections, locations, accessibility, all those issues will be big issues on deciding whether to locate in Scotland or, say, in Newcastle. What we're saying is if it comes down to the margin and those few percentage or even points of a tax can make a significant difference, then that might lead to a decision of an investment going elsewhere. That's, I say, we don't disagree that it is only one of a range of factors that will be made, making investment, but we still think it's important that where decisions are made on a much tighter basis than they ever were, it's important that we can at least compete with the UK on a level playing field.
Okay, thanks. Do the other two want to comment on that at all? Or? Okay.
To sound flippant, I mean, I guess I'm speaking on behalf of home buyers, general public, who, intuitively, none of us wants to pay any more tax than we need to. So, you know, anything that would reduce our tax, you know, it's hard to imagine anybody that wouldn't want to do that. And I refer back to
I totally disagree with that. I mean, and I think there's a lot of people out there who want better services and are prepared to pay better tax. So that is one view. I don't think that's necessarily right across the population.
But if I can finish my point, what I was going to say is that if by paying less tax on stamp duty, as if for instance, it stimulated much broader activity in the wide economy that generated tax income or other income for the government, then, you know, that I think is something that needs to be explored. As we've said, creating jobs, taking people off welfare, creating economic activity might, I only say might have a net greater effect. And that's where I think that maybe some exploration could be done. So hence my reason for suggesting that maybe that tax, if it were to be removed, could potentially maybe stimulate the market. I'm not saying permanently, but certainly in these current times, could stimulate activity that overall might have a net better effect.
And possibly linked with higher income tax to compensate then?
Why?
Well, you said if we boost the economy, we'd get more. So we need to get more tax in somehow to compensate for the loss of land and building transaction tax.
If it creates jobs and taking people off benefit, and of course they will then be paying income tax, then that could have a net positive effect, indeed, as well as all the other benefits that go along with that, with increased corporation tax as businesses become more productive.
Okay, thank you.
I think very quickly, all of that is in terms of trying to stimulate some activity for the construction sector. Maybe it's not just a discussion and an exploration into the level of tax, but also the timing and structure of that, which, you know, I'm certainly not qualified to go into the nitty-gritty of that, but maybe more David's field in terms of how the tax is paid over the lifetime, if you like, of a major commercial transaction.
Thanks so much.
Okay, Gavin.
I want to return to a point Michael Levac touched on, and this is the timing of the publication of the rates of LBTT and indeed the thresholds. The current government position, as I understand it, is that these will be published in September 2014 when the draft budget is published, and obviously will impact from April 2015. Presumably your members will want those rates published presumably today or tomorrow, as soon as could practically be done. What do you think, though, is fair and reasonable, being objective about it, about when the government should publish at least the top rate, if not everything? Do you have views on, is September 2014 okay? Is it too late? Do you have views on what would be an objectively fair time to present them?
Again, I'm not speaking on behalf of, whilst some of our members are developers as well as contractors, but generally I would say, just from personal experience, obviously the people taking transactions, particularly, or views on transactions, particularly larger commercial transactions, you know, they are going to be looking, these things take years to actually get the shovel in the ground, and certainly from September to April isn't a long time, particularly if there's a more radical shift in the way the whole look of the scheme and the structure and the tax. I would have thought we preferably would be wanting a minimum of 12 months, and probably if we can get towards 18 months would be preferable.
Okay, I wonder if other panellists have fixed views on that.
I think looking at if there is such thing as a typical home purchase, we know that the financial, legal and the process time is typically between 3 to 6 months from the date a person will sign on a registration form to the date that they maybe get the keys to their new home. So we're talking 3 to 6 months as a typical time frame. But of course then you have to add in the period before then of the home search process, the looking around, finding the property they're looking at. So I think it wouldn't be unrealistic to suggest that a 12-month horizon is probably not unrealistic in terms of most people's views as to when they, from the first point that they consider that they'd like to move to the point that maybe the transaction is completed. So to reinforce Michael's view, that I think 12 to 18 months would give adequate notice for organisations and indeed individuals who are considering to have some understanding about what the likely changes might be.
Does the SPF have a view on that?
So I would say that deals and transactions that might even be as far away as 2 years now are probably being considered potentially right now in certain cases, in certain very high value or major development investments. So yes, as early as possible, an indication where we'd be on the top rate commercially would be very helpful indeed. Do recognise, however, that SDLT rates can change overnight on a budget day, so we'd just caveat our answer with that.
Thank you. I'll stick with the Scottish Property Federation. You talk in your paper, you raised concerns about licence agreements potentially being caught by the tax. Can you just expand on that point a bit, please?
Yes, I think the licence arrangements are one that I believe HMRC had looked at a number of times and veered away with, and the problem here is just the sheer scope of licences that may be caught or not caught and may unintentionally be caught is probably the key issue. A lot of licence agreements can be done for perhaps seasonal reasons, kiosks or something around festivals such as Christmas in shopping centres and so forth. And I suppose the question is whether that's really the kind of activity that you're looking to tax in this instance. You'd also be concerned about perhaps very short-timed occasions such as Commonwealth Games, gymnast games afterwards, probably that are coming if you're looking at the timing. And the organisers of those events are competing on a worldwide basis, not a UK basis, and you'd be very keen to ensure that this kind of activity wasn't caught, although it might be very short in time. It could be a very large price ticket that's associated with it, so inadvertently it could fall under a licence. And similarly, I suppose if you're looking at the complexities of what kind of licence arrangements that you're trying to identify in terms of wider scale things, and airports and so forth, then are you trying to capture operators who may have an interest in land for the purpose of servicing an aircraft, that kind of thing, fuel, so on. There's just a huge range of complexity there, which I think forced HMRC away from this area. So our concern is that we maybe open a Pandora's box, which would have a lot of unintended consequences flowing out of it. Horrible phrase again, I know, but that's why I think it wasn't done beforehand.
It's helpful, thank you. Subsale relief. Last week the government explained to us why they didn't just mirror exactly the provisions from SDLT, and that was basically around tax avoidance, which seemed to have quite a lot of support. But some evidence has been given, and indeed some of your papers mention subsale relief and point out that a targeted form of subsale relief might be a goer, and might be better because it's not all about tax avoidance. There are some what might be termed sort of genuine commercial transactions where subsale relief is quite important. I just wonder if any of our panellists want to comment on that, and are there types of transactions where subsale relief actually might be quite important?
Forward funding for us, I think that's the concern, where you trying to attract an institution into supporting development. And again, this refers back to comments that have been made and are well known about the lack of debt finance for property development investment that's around right now. The institutions are seen as an alternative source of finance, and our concern would be that the measures as proposed in the bill could constrain that activity severely. So that's certainly something that we'll be looking to take up.
I wonder if, Homes for Scotland mentioned subsale relief in their paper. I just wonder if you want to expand at all on your position.
Yes, I think in our paper, at the point of writing this paper, we expressed some lack of clarity as to where we're at, and I hadn't seen any of the information that you mentioned. I'm not aware of that, so I'm not exactly sure where we're at on all of that. Subsale relief, the instances that I become aware of it is, for instance, if someone contracts to purchase a particular property, and then before that contract completes, for whatever reason, wants to pass that sale onwards to someone else, if they're unable or unwilling to complete that transaction, it would seem, our view is it would seem odd to have a double taxation hit on something of that nature, where if in effect no goods have changed hands.
Part exchange schemes could be caught under that, where you'd effectively have the property being taxed twice.
And finally, if I may, Convener, just if I return to Philip for Homes for Scotland, just another relief you touched upon is that I think you felt that registered social landlord relief ought to be broadened slightly just to reflect the position as it is in the marketplace today. Again, I just wonder if you could expand on that slightly.
I think that what we've the property market, the residential property market, is undergoing some quite significant changes from a tenure perspective at the moment, and just to sort of put that into context, traditionally that the market tended to polarize between social people who were living in social rented properties and people who were owner occupiers. What we've found with the lack of availability of mortgages in recent years and the other issues around the property market, as we've heard, is we've seen a much more fragmented range of tenures coming on board, with shared ownership, shared equity, mid-market rental, and developers, home builders have had to be to stay in business, have had to rejig. Many of them have had to rejig their business models to provide homes of much broader tenures, so that the polarisation has blurred in many respects. And what we're looking for is for people who are purchasing or taking homes of different tenures, that we look at where the SDLT or where the taxes would apply there, rather than saying it's a simple black and white. There are much more shades of grey now in there, and that's why we're saying that we think those other forms of tenures would require some examination to see whether they should have different tax treatment.
Thanks. By Jean.
I mean, it's obviously going to be crucial in 2015 what's the calculation of how much money should be taken from the block grant, because it's assumed that's what the existing tax brings in. But I was concerned in terms of the Scottish Property Federation. You highlighted this in some detail, firstly about the volatility of the tax, and we kind of know about the big changes since 2007, but you also had the interesting comment that the Q4 commercial property figures from 2010 really skewed some of the estimates that the government had made in its consultation paper. And then even more alarmingly, you go on to point out that it's not clear from the data exactly how much is raised by these taxes at all. And the most striking comparison, I think, was the Scottish Government's consultation suggesting 65 million from commercial leases, and then you say, based on HMRC data, it's a figure closer to 17 million. So there's a lot of concern there, because if we get this wrong, then we're not off to a very good start.
Yes, and I think there's an explanation first on the last point about leases. The 65 million actually includes where people have bought leases, so leases have been assigned. So around 45 million of that is in a sense a transaction to actually buy a lease, because someone needs to get out of a lease arrangement at that time. But even then, I think the figure was close to 125 million was suggested as being applied to leases at that stage of the consultation. But more recent figures, which have now been published, I think there's been further extrapolations of the HMRC data, now got that a bit closer towards 16 or 17 million, around that level. So actual leases themselves, you're talking around about the 16, 17 million. In fact, it's slightly odd, because on the Scottish Government's website, we had to go through the Housing Directorate to discover this figures that related to commercial leases. But the big bulk of that is actually on the purchase of leases, and that explains some of the difference there. But I think the larger point which you referred to was on the scale of revenue attributed to stamp duty, land tax, and on the lack of transactions that's been built up, and the Q4 figure which I referred to, which, I mean, we've been monitoring Registers of Scotland data on commercial property sales for several years now, and that is virtually double the average that we've seen in the last 3 or 4 years, which has been closer to 400 million. In fact, just yesterday received the latest figures for the end of last year, and that's now plummeted to 330 million. So it tells me that the OBR forecasts are, I think, are wildly optimistic, personally. And I think it's vital that the Scottish Government sticks its heels in and makes sure that the block grants, the Treasury aren't looking for much more than 200, 250 million. I'll put it that way.
Do you guys want to comment on that?
Only, I don't have the figures here, but I remember when the announcement was made that this power was going to be moving to the Scottish Government. I remember trying to research it and get the figures, and they weren't readily available, and the information from memory, that was probably over a year ago, was quite a time lag. It wasn't particularly current, but I don't have them to hand. I will go and dig them out when I go back to the office and just check that, and if I've got any other comments, I'll feed them into the committee.
Thanks.
I think that I have some data here, Michael. I'm not sure whether it's the data that you were looking at, but looking at the data that I have, the figures in 2010-11 compared to 2007-08, certainly on residential transactions, are more than 50% reduction. So from revenue on residential of 340 million in 2007 and 8, dropping to 165 million in 2010-11. Now, not being an economist or forecaster, but I think I'm reasonably close enough to the numbers to suggest that we see no signs of any significant movement in the housing market in terms of number of transactions or certainly the number of housing starts and completions. And our forecasts are we're unlikely to see any significant change in the coming years. Unless there are some dramatic changes that are outside of most people's expectations. So for the foreseeable future, our predictions of the market is likely to be flat, sadly, and that's against the context, as I say, of an increasing housing need.
So it may not be difficult in that sense to get the residential part of it correct, but I mean, could you give an explanation for the unusually high figure in Q4 2010-11 for commercial, because it does seem dramatically more than the other quarters that you give figures from?
Well, I mean, at the end of Q10, we hadn't re-entered recession. There was just simply a lot of unusual transactions at that time. But in the last, as I say, 8 quarters since then, I mean, the figure we had for commercial property sales, for example, just in that year, which would be the bulk of the revenue, was, I think, around 832 million just for that quarter alone, Q10-11. But every other quarter, tracking the sales data from Registers of Scotland, has averaged around 400 million. In the very last quarter, which just received yesterday, the sales for that quarter was at 330 million. So sales is an indicator of the revenue to be obtained. It would suggest that for the years since then, and in fact actually for a number of the quarters running up to Q10-11, the take for the revenue would have been significantly shorter than for that particular quarter. Mm-hmm.
Okay, so I can just ask a second question, which is of quite a general nature, given that a lot of the details have already been covered, but assuming that the UK government gets a figure which is credible and more or less correct for that, I mean, I suppose reading between the lines and reading your submissions, I'm assuming that you would really like to see a reduction in what's currently collected, because if I look at your submissions, and most of this has been covered in detail, but you know, Homes for Scotland's talking about extra reliefs, registered social landlord, zero carbon. I have sympathy for both of those myself, but obviously there would be a cost sub-sale, and then more strikingly, you're worried about the high end being too high, and perhaps most strikingly of all, you want the low end to come from 1% to 0.5%, which I think is bound to lead to a reduction in the amount of take coming in. The Scottish Property Federation also raises the VAT issue, so you would obviously like that to be taken out when the tax is calculated. and the other reliefs that Gavin Brown's mentioned, I think they have been mentioned anyway, disaggregation relief, intercompany group relief, and of course subsale relief, and then the Scottish Building Federation majoring on the energy efficiency issue. So I suppose my general question is, I mean, do you, in terms of what you're arguing for implicitly, want to see this level of tax perhaps halved or something like that in terms of the overall take in order to achieve other beneficial objectives, in your opinion? We've talked about the environmental ones, the climate change ones, but obviously other more general economic ones have been referred to, and obviously stimulating the particular sectors that you're involved in. I mean, would it be fair to say that implicitly you are arguing for a very dramatic reduction in the take from this particular tax? I don't know if you can quantify it. I've suggested you're perhaps suggesting it should be halved in total. I mean, have you got any kind of figure or notion in your own mind about how much you would like to see this tax raising in terms of its overall effect on the wider economy?
Can I maybe make probably a personal point, if you like? We've had the debate earlier in terms of it's okay reducing one area of tax income, that's got to be balanced with something else going up. You know, we all understand that in terms of balancing the books, and it's certainly not easy at the moment. I suppose from a personal point of view, if you think about it from buying a house that's going to be your home, I suppose I've always scratched my head and thought, what actually is this stamp duty for? And you could argue to varying degrees, other tax that we pay, you have a closer association or understanding of what that's going to pay. Yeah, I know it's not quite that simple, and we could open up all sorts of debates, but you understand, what your council tax broadly is going to pay for. Income tax, you could argue about VAT, maybe duty on associated with running a motor car. But in terms of stamp duty when you're purchasing your home, and it can obviously be a fairly considerable figure depending on what value you're purchasing at, I suppose there's not the connection maybe between, what is that then getting used for? And if there's a chance to maybe make Scotland a fairer place, and a place where the people that are paying these taxes actually understand, well, what will that be used for? I think that would be welcome. So
were you arguing we shouldn't have it at all then? Or?
Well, I mean, no, I'm not going to be drawn into commenting on such a ridiculous proposal. There's lots of taxes we would all like not to pay, and I think we've all recognised and given our evidence that any of these measures, none of them are going to cure everything, but it's part of a wider, it's a complement, a suite of policies that hopefully will stimulate activity in the construction and property sectors. But what I'm arguing about is maybe we should take the chance in Scotland here to establish a closer link as to any money that's coming in from LBTT, whatever rate it is, what is it going to be spent on? So we actually understand when we're buying a home what that money's going to.
Yeah, hypothecated tax for
rather than just going into a pot where you don't understand the connection.
Well, that's a wider argument, but fair enough.
First 2 points I would make. First, on the VAT issue, yes, on commercially there would presumably be some kind of revenue, but I suppose our comments are and always have been that we just think it's wrong that you have a tax based upon another tax, so double taxation. On the relief side, a lot of those reliefs are already in play now, so they're already integral to the forecasts which have been made and the revenue that's collected now. So I think that would perhaps reduce concerns in terms of giving money away.
I think that the point that I would make is what we're talking about. Well, I'm talking from a residential perspective here, not commercial. But we're talking about an item that every one of us needs, a roof over our head. It's not a discretionary item. We have to have a roof over our heads. And by looking at how we can best put roofs over people's heads, we need to think of the broader picture. Because if we make home ownership more difficult or more expensive, people will then be forced to look backwards towards the government or the state to provide housing for them. And so the need has to be met somewhere. So it would make sense for those that can afford it and those that want to make home ownership available, accessible, and for those who choose not to or are unable to enable resources to be directed towards those. So we should ensure that we have a balanced housing market that supplies housing need as appropriately driven. And by taxing it or making it unaffordable, we're not saying, oh, well, it doesn't matter. Those people will still need a roof over their head, and they'll be looking for the government then to provide housing grant to RSLs or fund other forms of housing, which may ultimately be more expensive in the longer term. So I think we need to, as I say, broaden the thinking outside of stamp duty or LBT tax and think about how we meet housing need and what ultimately is the most economical and efficient and effective means of providing that need.
Okay, just on that point, actually, I mean, you've mentioned earlier in response to John about, you know, if you reduce the number of, the amount of LBTT, it'll stimulate the economy, there'll be less people on benefits, etc., etc. But of course, this Parliament takes the hit in terms of its revenue. The income tax and VAT that we generated would go to the UK government, so we would still have a reduction in income, which means we would have to reduce our own services. So you know, and that's assuming that the balance is equal or even positive. I don't think any information has been provided to the committee to suggest that a reduction, as has been suggested, will actually provide that the level of stimulation which exceeds the loss of revenue to the Scottish Parliament.
Well, I certainly wouldn't be able to provide that type of macro level statistics and analysis. It's outside the remit of our core skills. But what I would say is work that has been produced in the past shows a multiplier effect of about 2.84 for every home that's built. It creates 2.84 jobs. Now, if we, logically, we build homes that people need to live in, creates jobs, takes people off unemployment, puts a roof over their head, taking them off benefit, and at the same time creating activity. So there is a virtuous circle in all of that.
Everyone would agree with that, but it's whether reducing LBTT from 1% to 0.5% will have that effect is the issue that we're trying to kind of pin down. You know, I mean...
Yeah, I cannot provide you that sensitivity analysis. We don't have that.
We'll try and explore that for other avenues. Thank you. Sorry, Jean, to be followed by Michael. And just to apologise for Jamie, he doesn't feel well, which is why he's left the committee for the time being. Jean.
Thanks, Convener. In earlier sessions, the potential for this new tax has been met with a certain amount of enthusiasm. I mean, I felt that it was giving opportunity, and I think in each of the paper there's a hint of that, if not using that word in all of them. And yet we're referring back to, or what I'm hearing today is a slight kind of a nervousness about a change from the UK system, don't upset the horses sort of thing, where I had seen this as a real opportunity, and the UK system, I mean the stamp duty land tax is not seen as a perfect tax by any manner of means. We know that there's loopholes in it, tax avoidance and so on. It's riddled with things that we'd all want to change. And yet today there's a kind of slight hesitancy about why we would want to do that. And it seems to me that there's a real opportunity to change this for the better. I mean, is that broadly something that you agree with? And if there was one thing that you would like to see in this new bill that would give a great deal of comfort, and I'm not talking about just abolishing it or reducing it, I think we have to move away from that. That undoubtedly will be a tax. What would that be? And just one other question as a kind of supplementary. It's an earlier statement that was made, I think, by you, Mr. Hogg, in terms of energy efficiency really not being an issue for people. I mean, that did quite surprise me. And I'm thinking of the kind of incentives that the Scottish Government has been using, the leaflets that come through every day, the advertisements on television, the awareness raising of climate change and all of these issues, but particularly the pound in everybody's pocket, is ultimately what makes us switch off a light or be aware of not filling the kettle. So white goods, I think, are a particularly good example where they have the you know, a band showing you how energy efficient they are. And I think I would slightly want to challenge that you think that people are not energy aware. So there are just two comments, but particularly, is this a real opportunity? Can we get excited about it? And what would be the one issue that you would like to see?
To answer your first question, yes, I think it is an opportunity to make the progressive system more fair, to remove out the slabs and the stages. And I think in my paper I quoted an example about where certain homes are just uneconomical to build, where there might be legitimate market need for them, but they just don't stack up economically. So I think that there is an opportunity for the progressive system to remove these log jams and these artificial peaks and troughs. And also I think that there is an opportunity, as I said earlier on, to incentivise low energy, low carbon homes, to give added incentive and send the right signals to consumers. Moving on to the second point, and just, I don't wish to sound negative and from the Flat Earth Society, but I have to be realistic and tell you the feedback that I get from our members who are at the coal face. And I have a meeting with many of them this afternoon. These are the sales and marketing people who sit in the sales offices week in, week out and sell homes to people. They've said on numerous occasions to me, if you pick up any newspaper and look at new homes advertisements, we've challenged them, well, why don't you advertise energy efficiency? Why don't you say, you know, you save on your gas bills, your fuel bills? It is not an incentive that's proven to have wide-ranging appeal. The majority of home buyers, and I'll caveat by saying the majority, there are some, the majority of home buyers are still looking for the fundamental important things when they're considering a new home: location, price, layout. Does it suit my family or my particular circumstances? And the energy efficiency, if they walk into a new home, they assume it's a given that it's going to be energy efficient, and it's a given that my fuel bills are going to be lower than maybe the home I'm moving from. So that's just taken as granted. So to drive even further and say, but you may save another 100, 200, 300, whatever the amount might be on your fuel bills a year, is not a significant lever that is going to make a purchase decision one way or another. So that is the reality, and I would challenge members around the table, if the mood takes you, visit some new homes developments over the weekend, go and talk to the salespeople sitting on the sales desks, ask them how many people come in and talk about energy efficiency. That is the reality that we face. It's not a particular strong lever in terms of encouraging people to buy new homes. It's a fact. Hence the reason, if the government wants to achieve the carbon reduction targets that have set, it's going to take more than education, more than just sort of encouraging people and persuading them. It is going to take financial incentive, and hence the reason we're suggesting that having low carbon or low energy efficient homes, having some incentive in the LBT system, is an area that we think should be explored. And I move that on to suggest maybe even progressing that further in other methods. But as I say, that's the reality. I don't necessarily personally like passing that point across, but I have to reflect what the reality is out there in the real world.
Just to add to that point, Philip, say time and again, I think both or all organisations have said to the RICS, the valuers, why can you not reflect energy efficiency improvements in the value of properties? And their answer is, we don't make the market, we reflect it. And the point is that people simply aren't attaching a significant enough value for them to make that decision. And I don't know if you're going to be speaking to the RICS, but I would encourage you to do so, because I just don't think you can differentiate taxes on interest in property and that from the value of the property. And, you know, they are the valuation professionals. So I think that supports Philip's point, the fact that the valuations are not perhaps where we'd wish them to be at this moment in terms of reflecting energy efficiency improvements. On the broader point in terms of that this is an opportunity, well, I think we have broadly welcomed the bill, and I think today just the nature of the cut and thrust that we're looking at some specifics and opening up some wider concerns that we have. And for us, I think both the approach and the general principles that the government and their officials have adopted towards implementing the bill have been very good. I have to say that. With the one addition, I suppose, from our point, that we keep pushing the point of you must be competitive, and actually we do see this as an opportunity. It's an opportunity potentially to differentiate ourselves from other parts of the UK, because we're in a very hard struggle to attract investment right now in this particular sector. And so, yes, we do see it as an opportunity to get a simplified bill, a competitive bill, and if we can differentiate, yes, we've mentioned the things on VAT and on we don't have the figures, Convener, which you referred to earlier, but it's those kind of things which can perhaps drive a perception of Scotland being a place that's open for business and looking to attract people in.
Very quickly, in terms of energy efficiency, I think there's a lot more we need to do in terms of changing people's sort of culture and behaviour, both looking at new build and existing stock. And I mentioned earlier the so far total lack of impact of the Green Deal, and I don't hold out much hope for that changing things. So that we've got to look at every policy that can contribute in some small way to maybe changing that culture of how we look at energy efficiency. In terms of whether this is an opportunity, we've clearly stated in our written evidence and in our conclusion that we're supportive of the general aims of the bill, and also believe that restructuring of the tax in particular offers important opportunities to eliminate the market distorting anomalies that have been touched on earlier by my two colleagues. So yes, we welcome it generally and see it as an opportunity.
If I can just add one more point, picking up on David's from RICS. The government has produced its Sustainable Housing Strategy document last year, and one of the 5 themes of that document talks about financial market transformation, getting the financial market to reflect energy efficiency in homes, which is exactly the point that David was making. And when in discussions with lenders and saying, well, why can't we value or lend on a property that has higher or lower fuel costs or higher energy efficiency, their response is always that there is no evidence that just because the running costs of a home are less, that cash or that money that's released would be or could be used to fund a mortgage repayment. So therefore, they cannot value that. These are their words, they cannot value that in. So until we break that logjam, where new properties are going to be valued at exactly the same rate as the old ones, the cost of progressively building new properties is going to make them unviable. So that financial market transformation is desperately needed so that the running costs of a property are reflected in the value, but we're just not there yet. We're a long way off it, sadly. It's going to take some major movement to have that reflected in value, and that will then start to make the market more reflective, and hence the reason why I think all of us have referred to that particular point in our papers.
Yeah, so just a comment. I mean, you referred to the climate change debate that happened in the report rather on the climate change targets, but in the same week we had the debate about fuel poverty. And these are realities that have to come, and I think that the industry that you're all in must reflect some of or contribute towards changing the culture that allows this to happen, because it has to be the future. And if we look at any other country across Europe, that everybody is concerned with that. But it seems to me that there's a real opportunity, and I hope you would agree that we could actually change how things are done in the UK. I mean, there's clearly a very poor taxation system, riddled with holes, that can be renewed and revitalised in Scotland, that might actually influence it elsewhere.
To reiterate, we are broadly supportive, which I think we do state in our paper, of the general direction and theme of the proposed changes.
Just quickly, in terms of that specific point, that's why Scottish Building Federation joined forces with the existing Homes Alliance. Indeed, we're a founder member with other organisations that are very much looking at maybe fuel poverty and maybe they're odd bedfellows for us, but we're trying to work with them to look at the existing housing stock and try and work very closely with government, because it's not just all about grant funding. There's a whole people's perception that's been touched on, a whole host of issues. The one thing we're very clear we do not want to get into is this debate and argument, new build versus existing. We need to take measures on both, but they need to be proportionate and they need to reflect the current economic climate.
Thank you.
Michael.
Thanks, Convener. It's a question of clarification for David Malouche. In your paper, you conclude in relation to the progressive versus slab approach. If the government moves to introduce a progressive approach to residential property transactions, then commercial property is likely to follow. That sort of raises a question about whether there is going to be a progressive system within this. In your conversations with government officials, do you still have a doubt in your mind that they want to move to the progressive?
I'm not in any doubt they want to move to the commercial. I think it's more reflecting the reality that in the commercial world, most of the transactions hit the high band as it stands at the moment. So there was more of a question mark over, in many ways, the necessity, because really it's the distortive impact on the residential world that this progressive system will deal with effectively. So, but we're not in any doubt that, I mean, really just administratively, it's likely to be, it's going to be on both. So
yeah, that's helpful. And sort of a final question, John Mason asked the questions in the area that I was interested in. I suppose it's common sense that any business looking to invest, or even in the current climate to consolidate or contract, would look at the tax regimes in different jurisdictions and make a decision taking all of that into consideration. Have any of your organisations done work on to what degree that sort of marginal difference starts to become effective, or can you point to any academic work which shows where it becomes a significant factor when these decisions are being made?
I think I think the government actually did it in their initial consultation in terms of tipping point when it starts to be more tax made. I think it may become significant when you get to very high value commercial transactions, and from major investors. It will always, as I said earlier, be one factor in a range of issues, and we want to be quite careful about, but it could have an influence on very high value commercial transactions where, depending on what the differential in any rate is or might be, it could have significant consequences. If you're talking about £50 million worth of property transactions, then it might stack up and start to look as if it sort of becomes a cost that you may wish to look elsewhere. I'd want to be, as I say, caveat, it will be one item amongst a number, but certainly the pressure that's come to us from investment developers is to try and at least match that UK rate, so that kind of differential is just put out of play for those kind of investors.
I think as a general theme, and I don't have specifics, but in conversations that we have, first of all, we have to understand that the new build market, which clearly I speak on behalf of, the total output of new homes is heavily dominated by 3 or 4 big PLC home builders in Scotland, who are based down south. So a good chunk of the homes that are provided are by these major organisations. And typically their view would be that at the start of any business year they would have an investment fund of X million pounds to invest in land. And they would allocate that land or that spend depending on where they thought they would get their best return on investment, clearly to satisfy their shareholders. So they would then challenge each of their businesses throughout the UK to put forward projects and demonstrate the return on investment for those projects, and effectively a tendering process. So the projects that were thought to give the best return on investment would clearly then be the ones that would secure the funding. So what determines the return on investment? Well, what determines the return on investment is the market demand and the cost of supplying those products. So anything that affects demand, of which stamp duty land tax is one, can either positively or negatively affect demand, and construction costs. Those are the two variables. And again, so any increases on construction costs or the cost of delivering those homes is going to necessarily impact on the return that particular development will make, and could impact positively or negatively on the decision to invest in that development or that part of the country. So these are the sensitive issues that we're managing, and all changes to legislation, be it stamp duty land tax, be it changes in building standards, we have to assess the impact on those with our PLC members, because the last thing we would want is for them to determine that actually our money is better invested in other parts of the UK and withdraw funding and support, which would not only impact on housing output, which is already, as I say, would contribute to the housing crisis, but it's the knock-on effect of the loss of jobs and the consequential subcontract work that drops out of all of that. So these are sensitive issues.
It's helpful, thank you.
Just thank you, Michael, and thank you to colleagues for the question. Just on that last point, what would be the cost, for example, of building a two-bedroom house in Scotland, roughly, in London, for example? What would be the difference in costs?
I couldn't quote you those figures offhand.
What would be the margin? I mean, you think about London with the terms of land costs, labour costs, etc., etc. So obviously, demand is the ultimate, is the most important, most significant thing, and the ability of banks to lend, is it not, to prospective buyers?
Whilst costs will be higher,
price.
So would the respective selling prices. So that it's the margins that are important. I think that we've seen already in the last 2 or 3 years some home builders, some national home builders, that have withdrawn activities in Scotland and decided to concentrate their efforts in the southeast, rightly or wrongly, where the market is somewhat more insulated and has a completely different characteristic, i.e. much more towards foreign investors, and where there are other forms of available cash.
Just thank you for that. Just a question or two to Mr Milhouse, just to wind up. You talk about very high commercial transactions, and you quoted a figure of £50 million. What would you define as a very high commercial transaction, just so we know, got a ballpark about what we're really talking about?
I would, I think now I'd probably look at, I'll say 10 million upwards, around there. I mean, the number of transactions is much reduced, and so I would say that in terms of high value, to give enough of a significant difference between where you get to, I think, residential high value, you start talking about, for taxation purposes, £1.5–2 million worth, and now where they trigger 7%, I think it's 7% at 2 million, is it, Philip? I think something like that. But commercially, I would certainly say 10 million upwards, because although there's much fewer, they do tend to be of a much higher value in terms of investment sales.
Okay, and in terms of your graph about the value of Scottish commercial property sales, which I understand you took from the Registers of Scotland, and you may just have presented it as they presented it to you, but the way the figures are presented on a quarterly basis looks as if the situation is much more unstable than it is if you actually look at it by comparing quarter to quarter. So although over the piece there's a roughly 24% reduction in sales, if you actually look at, for example, quarter 3 in 2011 compared to quarter 3 in 2012, there's virtually no difference whatsoever. Would it not be better in terms of presenting such figures on an annualised basis rather than a quarterly basis?
Yeah.
So they get a clearer picture of what's actually happening?
Certainly. I mean, what I'd say now, it's stabilised. I mean, before the crash, you'd probably be looking at around about 6 billion transactions, and now it's about 1.2, so it's about a quarter. Right there.
Interesting to see those figures over a longer annualised basis.
Send those along
if you could do that, I think that would give a much clearer picture to the committee. Well, thank you very much. Actually, that's been very, very helpful to our deliberations. You're scheduled to be here for 90 minutes. You're here for 92, so kept within our time. And once again, thank you for starting early. I'm now going to call a 5-minute recess. We'll start back at 11:28 so that colleagues can get a natural break. We shall reconvene the session. The final item of business today is to take evidence from the Scottish Government Bill Team as part of our scrutiny of the post-16 Education Scotland Bill's financial memorandum. Can I therefore welcome to the committee Mr Michael Cross, Gavin Gray, Tracy Slavin and Scott Mackay. Good morning, everyone. And I understand that one of you has a brief opening statement. It's not Gavin, I don't think. Can you join us, Gavin?
It's me, convener, Michael Cross, okay. If I may. Thank you very much indeed for your introduction, and thank you for inviting us here today to discuss with you the provisions, the financial memorandum, rather, of the Post-16 Education Scotland Bill. I thought it might be helpful at the outset just briefly to set out the context in which the bill sits and to give a brief overview of the three areas where we expect a financial effect. So the bill is an important part of the government's reforms to post-16 learning, and there are three overarching principles that shape that programme of reform. First, to secure a system that is better focused on getting learners ready for work, and thereby aligning with the government's ambitions for jobs and growth. Second, to improve life chances, particularly for young people. And third, to create a sustainable system for the long term. The government consulted twice on these proposals through putting learners at the centre, which set out our ideas for the wider post-16 learning agenda, and subsequently through a specific consultation undertaken jointly with the Scottish Funding Council on college regionalisation. The reform programme is also proceeding in the light of independent reviews of university and college governance undertaken respectively by Professors Ferdinand von Brzezinski and Russell Griggs, and their work too was subject to consultation with stakeholders. So that's the strategic background. Turning to the bill itself, college regionalisation forms its most substantial part. It's a central element of our wider college reform programme, itself well underway. But the bill is not needed to deliver college mergers or the significant efficiency savings that the SFC, the Scottish Funding Council, expect them to realise. It will, however, establish a new approach to college governance, supporting the new regional structures and reflecting the different approaches that colleges themselves are choosing to take. As the financial memorandum makes clear, there are costs associated with the new governance arrangements. We estimate the most significant relate to the establishment of new regional boards, and we estimate a recurrent cost of some £560,000 for a regional board. It's worth saying that the assumptions that form the basis of this figure were developed with the support of a college assistant principal, herself a human resource professional currently seconded to my division within the Scottish Government. We also shared our assumptions with the college legislative group established by the then Scotland's Colleges, now Colleges Scotland, so as to allow a group of college professionals to act as a sounding board as we developed the bill. The aim of the new governance measures is simply to deliver Ministers' ambition for greater diversity in college and regional boards. The proposed new arrangements for boards, constitutions and appointments will improve public accountability by clarifying what is expected of boards and their members. And it will do so in the context of the existing arrangements for clear accountability for funding and in the context of the new regional outcome agreements. The second area of the bill where we expect some costs is the new power to ensure the Scottish Funding Council can proactively review the structure and provision of fundable further and higher education. The SFC already has a duty to exercise its functions for the purposes of securing coherent provision, but the bill provides a more explicit mechanism to conduct a review of the overall delivery landscape, giving SFC a clearer remit to use the evidence it has to ensure the structures we fund operate as effectively as possible. We believe such a power is important in giving the Council a clearer mandate to discuss with institutions evidence of, for example, unnecessary duplication that's to the detriment of learners and to wider public investment. We sought advice from the SFC on the potential costs of such a review. We know these would not be incurred annually. They depend on the scope of the review undertaken. And the third area where costs arise is in data sharing. Here, the bill provides for ministerial powers to develop secondary legislation specifying bodies required to share data with Skills Development Scotland and set out the information that needs to be shared. The background is that for some years, Skills Development Scotland has operated a client management database system that allows staff to target their activity at young people at risk with a view to re-engaging them in education. We estimate the cost to partner organisations, the provisions proposed here, at around £52,000, and we base this on the experience SDS already has with other partners such as local authorities. We do not expect additional costs to arise from the bill's other three provisions on higher education governance, widening access or tuition fees. So I hope that provides a helpful overview that sets the context for our discussion of the financial aspects of the bill. Convener, could I conclude by saying, as the clerk I think is aware, a combination of circumstances means that our two colleagues working on college governance are unavoidably absent today. We shall do our best to answer your questions on this matter, but it may be that we need to write to you on those matters, and if that's the case, we'll do so immediately, of course. Thank you very much.
Thank you very much for that opening statement. And before I open the session out to committee, I will of course start off with some opening questions. I have to say that we've dealt with a number of financial memoranda over the last few months, and what seems to be clear from all of them is that the Scottish Government never errs on the side of generosity in terms of its financial assessments, and stakeholders never believe that adequate funding is available. So we always have to interpret the realities, perhaps being somewhere in between. And you talked about widening access just as you closed there, Mr Cross, and I have to say that Universities Scotland take a completely different view from the Scottish Government on that particular aspect, as you're no doubt aware. They say, and I quote, the cost of attracting, teaching and retaining at widening access students were around 31% higher than for students from more privileged backgrounds. The cost they estimate to be approximately £2,325 per student per annum. So how is it therefore that the Scottish Government is of the view that there would be no additional cost in terms of widening access?
Convener, I'm going to ask my colleague Tracy Slaven, the Head of Higher Education and Learner Support, to pick that question up.
Thank you. I think I can answer that quite directly. Widening access activities, particularly around outreach and retention, are already significantly funded to the tune of around £29 million per annum by the Scottish Funding Council. Our progress on widening access has been steady, if unspectacular, in that area, but there has been no suggestion that it has been underfunding. Well, certainly SFC has had no indication that that is the cause for the slowness of progress. So a little bit surprised to see that argued, but of course we'd be more than happy to have rather belated conversations on that if any of the institutions believe that is the case. I think I should also reflect directly on the report which underpins that assessment of a 31% additional cost. The report is based on data from 2002 in England, and of course, simply because of that historic nature of the report, cannot reflect in any way the substantial funding that has gone into widening access in Scotland, the different distribution of disadvantage in Scotland relative to England, or the fact that recruitment, retention and outreach activities in universities have changed dramatically over that period. Things which were only considered as routes for widening access potential students in 2002 are now mainstream activities for all students. So I'm rather bemused by the basis on which that evidence was put forward.
Yes, I mean, I understand your response to that, given the time lag and the changes that have happened since then, but are you therefore arguing, however, that there'd be no additional cost whatsoever, which seems to be the case here? I mean, surely, although the 2,325 figure may be completely inaccurate, I don't know if it is or not, obviously, but I think it's important that we look into that further. But surely there must be additional costs if you are going to widen, if you're going to have a group of people who are more likely to drop out of university and who need further support for financial or other reasons. Or do you expect, if the number of people from that group increases by, say, I don't know, 20, 30, 40%, there would be no cost. Surely there must be an additional cost in providing these additional services. Must be.
Well, in terms of student support, that is very much out with the provisions that we're dealing with in this bill. There has already been substantial changes to the student support package introduced for 2013-14, specifically designed to help support widening access and retention by providing the minimum income for low-income students of £7,250 per year and a minimum student loan of £4,500 for all students. That has already been provided out with this legislation. So in terms of student support, those issues have been addressed within the spending review already. In terms of the activities of the universities, the financial memorandum indicates that the additional costs are marginal rather than zero, and I think there may well be changes within individual institutions which are greater in some places than in others. But in terms of the provision across the sector has been engaged in widening access activities supported by the Funding Council. And as I said, there'd been no indication that they believed that that was underfunded. The issue in this case is in moving with these provisions from activity into outcomes for students. And it's that translation and commitment that we're looking for within the widening access agreements. Remembering, of course, that the widening access agreements are agreements which are reached by the institution with the Funding Council. They are not being set targets within the legislation or indeed but directly by government itself.
Not being set targets, so have you any kind of ballpark figure as to how many additional students would gain access through this?
Well, we have already provided additional places of around 2,000 for students in widening access type activities and in articulation. So additional places have been provided by government to address issues around headroom, which was one of the issues which was raised by the research-intensive institutions as being the key issue in addressing widening access rather than the funding of widening access outreach or retention issues themselves.
Switching to colleges, thank you. Switching to colleges, the regionalisation agenda will produce expected savings of approximately £50 million by 2015-16. I have to say, I'm always very suspicious of round figures, 100 million, 50 million, 25 million. If you said to me £47,233,411, I might be inclined to think, that was an accurate assessed figure. So how do you come to that figure of £50 million? And indeed, that'll be the first. I think that's enough to be going on with. How do you come to that figure first?
The figure of £50 million is one. This is a matter for the Scottish Funding Council, who itself is supporting the programme of mergers currently underway in the college sector. And as things stand, and drawing on the experience they have of several previous college mergers, the Scottish Funding Council have estimated a figure that I think its chief executive has made clear is a round figure of some £50 million. There's been an extensive exchange of correspondence on this matter following the report from Audit Scotland last autumn, and both the Director General for Mr Russell's portfolio and the Chief Executive of the Funding Council have written to the Public Audit Committee to make clear the latter, to make clear the basis of the Scottish Funding Council's assumptions. Now, if you'd find that helpful, it is out with the terms of the bill as it stands, of course, because the bill is not necessary to deliver the mergers, but we would happily copy you that correspondence.
Okay, that would be useful, because the College of Scotland in the submission talk about the £25 million College Transformation Fund, which will assist the process. However, this is unlikely to be enough to meet all the costs of the merger, although they haven't provided details of what they anticipate the cost to be. I'm just wondering if there's what the kind of level of discussion there is over this particular issue, and whether the gap is closing between their assessment and yours.
Well, the matter of support for mergers is one that we continue with the Scottish Funding Council to talk to colleges about, and we do that on the basis of the merger in question. The costs of merger will clearly vary from merger to merger. The government has made available a £15 million College Transformation Fund. The Scottish Funding Council has access to strategic funds itself that it supplements, that supplement the transformation fund. I'm not sure if those are of the order of 10 million, but that would get you to the 25 million pounds that Scotland's colleges talk about, Colleges Scotland talk about. And the prospect, I think, is of continued support for mergers in order to ensure they happen on time.
Okay. Sorry.
I just wanted to add that the Funding Council letter to the Public Accounts Committee does make reference to providing additional merger funding in subsequent years and to an estimated cost of 54 million in one-off expenditure funded through a combination of SFC strategic funding and College Transformation Fund.
Okay. Now, VAT has been an issue which has been raised. I mean, the new regional boards created by the bill cannot be registered with VAT and therefore are unable to claim recoverable VAT in non-business activities. But Colleges Scotland state that many of the predicted costs in the financial memorandum related to regionalisation appear light, and suggest it might be prudent to consult a VAT expert to ensure that costs can be minimised within regional strategic bodies, etc., etc. I'm just wondering if that's taken place. A VAT expert has been consulted.
Well, we consulted with the VAT expert within Scottish Government. Our initial assessment of whether or not the new bodies would wish to register for VAT was based on an analysis that the bodies would be similar to non-departmental public bodies. As such, they'd only be able to recover the element of VAT that's in respect of their business activities, with the vast majority of their activity being related to education, which is exempt from VAT. Our expectation is that initially there'd be very minimal amounts of VAT that they would be able to reclaim, and as such they may choose not to register for VAT initially. And the financial memorandum was prepared on that basis. That situation would be subject to review in the nature if the bodies themselves then investigate cost sharing, which my understanding is the bill makes provision to allow that to be explored but does not require it.
Just to come in there, Convener, the bill makes provision for regional bodies to operate in economic, effective and efficient circumstances. So were those criteria met, then the colleges would pursue that, as you suggest, Scott.
There is new legislation specifically looking at cost-sharing groups, which we believe would be applicable in this instance, but that would need further activity once the bodies were established. And my expectation would be that there'd be a review of the VAT position as cost sharing was explored.
Okay, just one last question before opening it out to colleagues who are all champing at the bit to come in with questions. In terms of the regional strategic bodies, the ongoing costs of £110,000 per annum, including VAT, have been estimated, but again, there's concern given to committee these costs, which are expected to cover new premises, insurances, licences, audit fees, membership fees and staff training, to name but a few items of expenditure, are woefully is a woeful underestimate. What's your view on that?
Well, we disagree. We have a detailed breakdown of the £110,000, ranging from the computing equipment necessary through consumables and hospitality, to travel expenses for board members, to recruitment of board members, professional services. We'd be happy to share those details with the committee. We don't agree that the forecasts are light.
Okay. Thank you. And switching to colleagues, the first person to ask a question will be Gavin, to be followed by Michael.
Thank you. I'll start with the simpler one. Data sharing. I think you've given projections for the cost of data sharing, which you describe as marginal. But in the helpful footnote, you say it'll be £52,000. Now, SDS say that is a likely estimate. College of Scotland say the estimate appears light. You say the money will be spent in 11-12 and 12-13. There is only 2 months left to go of financial year 12-13. So can you tell us today that this £52,000 has proven to be the right amount of money, and actually the issue is no longer live because all the work has been done?
So the main policy lead on this isn't here today. So I mean we are aware that based on SDS information that level is correct. I don't know for certain that is absolutely been spent, but we can clarify that immediately. Sorry.
Okay. Well, I mean, I don't want to press it if the right person here, but perhaps we could get just a letter on that. I mean, when the financial memorandum was produced, there may have been some dubiety, but given that we're fairly close to the end of the financial year when the money's spent for, we must now know whether it's enough or not.
Sure. I think, I think the position is that we are confident that the assessment of £52,000 is the best estimate we can provide you with. I think your point on timing is well made. It is unlikely that there will not be some slippage of this cost into 13-14, but we'll write to you to confirm that point.
I want to return to the subject the convener started with, which is the issue of widening access. First thing, I mean, you've heard what universities have had to say, University of Scotland have had to say, but they also say the cost assessment here has not been the subject of consultation with University Scotland or with member institutions. Is that correct?
There has not been a specific consultation in relation to the preparation of the financial memorandum. However, conversations in relation to widening access costs and the provision of support through the Funding Council for those outreach activities that I described earlier has been ongoing and has been for a number of years. And as I said earlier, there had been no indication that those issues were underfunded.
But in terms of the financial memorandum for the bill, when you've had informal discussions then, if not formal consultation with institutions and University of Scotland, have they said something different to you to what they're saying in the written evidence that we have received?
As I said, there has not been a specific conversation in relation to the financial memorandum.
Okay. Has there been a specific conversation then with either universities or University Scotland about the costs of widening access as a consequence of this bill? No. Okay. I suppose at least obviously, why has there not been a conversation in terms of working out the costs? Why would you not ask them about that?
Simply because it has been part of a very ongoing conversation around widening access. The universities are involved in drawing together the plans for existing outreach activity. They have been involved very clearly in the development of the widening access agreements that are part of their outcome agreements, and cost issues were not being raised as part of those processes.
Cost issues have been raised, obviously now on the record in terms of their written submission. What will the government be doing in response to that?
As I said earlier, I'm more than happy to have conversations with University of Scotland to see if we have any evidence or indication that is somewhat more recent than the report that was provided.
Now, the convener mentioned that report and the figure of 2,350, I think it was, which a figure you don't agree with. And he pointed out, I think, fairly the year in which that report was produced, and I think it did refer mainly or possibly exclusively to south of the border. So happy to take all that on board. What is your view then on the additional cost per student for widening access? They say it's 2,350 or thereabouts. You don't agree with that figure. You therefore must have some, to disagree with that figure, you must have some idea of what the cost is per student. What is it?
As indicated in the memorandum, we believe at the sector level it is marginal. That is because recruitment, the admissions process are all, as I think university said, intrinsic to the core mission of the university. Those processes are changing and developing over time. 5-10 years ago, the idea that a university would have a social media presence as a way of trying to recruit students simply wouldn't have been tenable. Those processes are all changing costs. Widening access is part of that mainstream activity. We are now simply, with the provisions of the bill, requiring that there are commitments to demonstrating the impact of those activities.
So if your view is that you can widening access, if I couch it in those terms, without any additional funding?
In relation to the provision of this bill, as I said earlier, we have made additional places available where that was indicated. That headroom provision of places was the key constraint for our research-intensive universities in performing against widening access targets, and we have provided student support that will remove financial barriers for widening access students, both having the aspiration and the ambition to go to our universities, so that we do that transition. It might also be worth reflecting that the UCAS statistics, which were released this morning, indicate that there has been a substantial transition around widening access already, with students from our most disadvantaged areas being 80% more likely to apply to university now than they would have been in 2004. So I think we have been on a journey which has already had quite a lot of impact, and those changes are already starting to be well embedded within the core systems and processes of the universities.
You made a reference earlier to a figure of £29 million. Is that an annual figure? Is that over a spending review period? Can you just clarify?
That is an annual figure.
Okay. Annual figure of £29 million for widening access as it stands. How many students are helped by that £29 million?
I would have to refer to the latest report, which I don't have with me. It is worth knowing that that money goes towards the funding of outreach activities, which obviously impact on a very large number of individuals, a number of whom then translate into being prospective applicants and then into students. But I can get a copy of the latest report to you.
Okay, but if you don't have it on your hand,
I don't.
But if you're prepared to furnish us with that, that would be very helpful.
Document from the SFC, so we can get that for you.
Thank you.
Okay, thank you. It's Michael to be followed by John.
Thanks very much. There were a number of consultations which took place prior to this bill coming forward, and we've asked people to comment on their participation in that. But Colleges Scotland have said in their response that the financial memorandum before us contains new proposals within the college regionalisation section for staffing structure and cost of the regional strategic boards and regional boards, and the proposed remuneration levels for chairs of regional college boards. But they go on to say that that wasn't part of the consultations initially. So, you know, can we trust the figures that you've come up with, given that they weren't consulted on and that all of these additional costs have been added without any reflection in the consultations?
I hope you can trust the figures. It is true that the estimates did not appear in the consultations that the government published, but the structure of the regional board was developed on the basis of those consultations. We did discuss with Colleges Scotland, or rather with the former Scotland's colleges, the content of the financial memorandum, specifically with a group that I referred to in my opening statement, the College Legislative Group. Now, that group comprised 4 current principals, one of whom is a regional lead at the moment, and a college chair. And the purpose of that engagement was to help shape, if you like, shape the content of the bill, which in turn reflected the earlier consultations. So, like Tracy, I'm slightly puzzled that Colleges Scotland say they are unaware of these figures. We think they are at the upper end of the likelihood of cost to be incurred by a regional board, but we did expose these figures to them in their development.
I suppose there's a supposition in all of this that these regional boards are just going to happen, that we will end up at the end of this with the structures that you envisage for them or the government envisages for them. Things aren't going well in Lanarkshire, though, in terms of regionalisation. So what happens if we don't end up with the regional boards in the way that you envisage, and we still have individual colleges not within the regional boards structures that this bill projects?
Well, in a region such as Lanarkshire, which would effectively be one region with a number of colleges in it, we would construct a regional board, and that would oversee provision in the region, working with the constituent colleges.
So there's going to be a regional board regardless of whether the colleges come together and form the structures that you hope or intend within the bill?
Yes, there will be a regional board in each region.
Okay.
Okay, John, to be followed by Jamie.
Thank you. Firstly, the Ombudsman talks about the potential for complaints, and I mean, I occasionally get a complaint from about a college or something, not that many. It says there's been an 18% increase, but they do kind of highlight that there's the potential, if there's going to be a lot of structural change, for an increase in complaints. Is the feeling that it's just going to be a marginal cost for them, or is there a wee bit of a risk in there?
Our view, and I think that of the Ombudsman, is that it is likely to remain a marginal cost.
I mean, if there was, quite a lot of movement of courses only being provided in one campus rather than another campus, I could foresee that would meet a certain amount of resistance.
Yes, it may meet resistance. That goes to the heart of regionalisation. What do we intend by regionalisation? We don't intend to reduce the offer available to learners. That's not Minister's ambition. However, the point on the Ombudsman, I think that if there was a large increase in complaints that the Ombudsman wasn't funded to accommodate, then we should need to take account of that.
So that would be something that would be kept under review, would it? Yes. Okay, thanks. And then the other point really was, I mean, I take the point that although we've been talking about mergers, technically mergers are not in the bill. Is that correct? It's the regions that are in the bill, and whether or not colleges merge is a separate issue.
It's a matter for the colleges, yes.
Yes. I mean, I think certainly in people's thinking, I think the two are very much interlinked. And I mean, one of the issues, for example, that's been raised with me is salary structures, which would be very different around the country, I think, at present. But presumably when colleges merge, they would have one salary structure within that college. And I accept, therefore, that would fall out with the bill. What I'm wondering about is somewhere in, like Glasgow, where you've got one region and probably 3 colleges. If they all have separate salary structures, would it be the region's responsibility then to bring that under control, or are they going to live with different costs? Because if they were to try and bring it all together, there would be quite a cost in that, I would think.
Maybe a cost in that, and that would be a matter for the region to resolve. If there was a significant additional cost, the region would have to take account of that in deploying the funding it would receive from the Scottish Funding Council.
Now, is that something in the Change Fund and so on, or the 54 million that's been mentioned, that would be included in there?
There is no funding provided specifically for a harmonisation of terms and conditions in the way that you suggest in that question, I think.
And is that because it's seen as purely a college merger function and not a regional function?
It's seen as a consequence, well, it could be, I should say, a consequence of college merger.
So is it possible that you have one region and 3 different salary structures within that region?
Yes, I think that is possible.
Okay, thank you.
I should add at this point, may I, sorry, just to supplement that for the record, that this is quite detailed territory in which I would normally look to my colleagues who can't be here to answer. If I've got that wrong, we should certainly correct it, but I think that is the position.
Jamie, to be followed by Jean.
Thank you, Convener. I just want to clarify a couple of things. So we're talking, and I want to talk about the college regionalisation issue. 9 out of 13 of the regions that have been established will have single colleges. That is my understanding. So can I just check the 4 regions that will have multiple numbers of colleges? They're Lanarkshire, Glasgow, Fife and the Highlands, is that correct?
No, that's not quite correct.
Correct me then.
Well, I'll try to do that. The regions that will remain single college regions are, I think, Dumfries and Galloway.
I'm referring to the 4 that will have more than one college.
4 that will have more, I beg your pardon.
Fife and the Highlands. Is that?
UHI will have more than one college. Fife is not expected to have more than one college. Glasgow will. As your colleague suggests, Lanarkshire will. And I think that completes the set because relatively recently the 2 colleges in Aberdeenshire agreed to merge. That's Banff and Aberdeen.
But it was Aberdeen and Aberdeenshire was the other.
Yes, it was once.
So it's now down to actually 3.
Yes.
But still, I'm a wee bit confused in terms of, there's a reference to the Highlands. The UHI isn't referred to as a regional board. Why is that?
No, UHI, well, Tracy, do you want to pick up the position of UHI? It's rather distinct from the college sector.
Essentially, the function of the regional board will be conducted by an FE sub-committee of the UHI Council.
No set-up costs or ongoing costs within the figure you referred to earlier for UHI?
That's a slightly different question. I think there probably are set-up costs for UHI, and the financial, the financial memorandum is not quite accurate on that point. I'm conscious UHI have made a submission in which they identify start-up costs, and we are talking to them constructively, I might add, about those costs at the moment.
We also referred, there's a referral to there being 3 boards and the £560,000 cost. Now you're suggesting there might only be 2 boards.
I am suggesting that,
so
yes.
So this £560,000 figure might come down?
It might well come down, yes.
Okay, well I presume we would recognise that as good news. Sorry, Mr. McCann.
Sorry, £560,000 wouldn't come down, but the aggregate of, I think, 1.86 million was based on 3 regional boards. Our expectation is that
£560,000 is per board.
Per board.
Okay,
yes.
that was my misunderstanding. Okay, so the aggregate cost will come down a little. Can you quantify the £560,000? Why has that figure been arrived at?
These are the figures that we spent some time talking to Colleges Scotland about, and they're the figures that have been influenced by an HR professional from the sector who's an assistant principal at the college at the moment on secondment to us. The staff costs we estimate at around £430,000, and that covers 6.5 staff. So we envisaged a position of Chief Executive Officer or strategic lead within the region, a strategic curriculum lead, an operational finance role, an ICT lead, a regional board secretary who would act part-time, and 2 administrators. Together that comes to £430,000, and then there are the on-costs of around £110,000 or so that we discussed earlier. There are then the costs of remunerating the chair. Those are the component parts of the global figure, but we should be happy again to send you those by way of a breakdown.
I think that would be helpful. Can I ask then where there's no regional board, because clearly where the regional board has been established, it's subject to a degree of oversight by the Commission for Ethical Standards of Public Life and also the SPSO. And we've talked a little bit about complaints, but can I just clarify where there is no regional board, these bodies will have no role and there'll be no cost implication for them?
Barring the remuneration, as we propose, the remuneration of the chair of that board.
What board?
The board would be the board of the single college.
Okay, so that will still be subject to...
That would become subject to remuneration, yeah.
But there'll be no role for the SPSO because they're incorporated?
That's a matter still to be determined by the Cabinet Secretary.
Okay. What happens to a regional board if that region ceases to have more than one college? Either they merge into one?
That would merge into one board, and that would essentially become the regional board for the region.
But I thought there wouldn't be a regional board because it's no longer a multi-college region, is the point I'm making.
Yes. So there would be one college, and that board would act as...
Would it, or would it cease to exist?
No, there would be one college in the region, and that college would have one board, and that would be it. There'd be nothing sitting above that.
So what happens to the... I mean, that's an interesting point, though, because then is that not a disincentive for these colleges to... I'm not saying there should necessarily be an incentive, but these colleges are then going to think, well, we merge and we'll have no say over who our board is going to be.
Well, I think the reality is that they would have considerable say in the constitution of their board. Part of the act of merging is to discuss what the joint board, the ultimate joint board of the merged college would look like.
I wonder if we're talking at cross purposes here. I'm talking about circumstances whereby a regional board has been put in place, appointed to deal with a region where there is more than one college, and we're talking sometime down the line that these colleges decide to merge. And in the other regions where there isn't more than one college, there is no regional board. Presumably, my instinct would have been that regional board serves no purpose anymore, it ceases to exist. But what you're telling me is, in fact, that it will become the board, the de facto board of the Mayor's College?
No, I'm sorry if I've given you that impression. There will be, well, I'm very sorry, because that's not the answer. There is one board that is constructed jointly by the merging colleges.
My initial perspective was correct, then the regional board will cease to exist.
There will be no public body where there was one.
Thank you, that's what I was trying to establish. I think we got there in the end.
I'm terribly slow on that.
I'm now.
Jean.
Thanks very much, Convener. In actual fact, my question mostly has been answered. You've answered it through Jamie Hepburn's questions. But can I just be clear about colleges that merger and how that has come around? Was there a desire for more colleges to merge? And is there an expectation that more colleges will merge?
I think the Cabinet Secretary has always made clear the attractions in merger, and Mr Batho's letter to the Funding Council, Mr Batho's letter from the Funding Council to Mr Gray at the Public Audit Committee makes quite plain the attraction of merger. So in the sense that merged colleges can provide a better service to learners, yes, there was encouragement to merge where that suited the colleges. If the second part of your question is, are further mergers in prospect? Yes, I think they probably are, for that reason.
Sorry, no other questions. Okay, that seems to have exhausted the questions from the committee. As we have no further items on our agenda, I'd like to thank the witnesses and call the session to a close. Thank you very much.